Okay, so we've looked at how we record the original purchase. We looked at purchase returns and discounts, which decrease the value of that purchase or the inventory. And now we'll look at freight in. So this is an additional cost to get the inventory ready for sale. So it's added to the cost of the inventory. Okay, so we'll look at first transportation costs in general. So a transportation cost is the cost of moving the inventory from the seller to the buyer. And these will either be freight in, and that's the transportation when you are the purchaser. So when you are purchasing those goods, because you are paying freight to bring them in to your store. So freight in means you're buying it. Freight out is transportation when you've sold something. So you are the one selling the goods because you're sending it out to the customer. Okay, so freight in, because it's us purchasing it. So in order to get that inventory to our location and on the shelf, if we pay this freight in, the cost is included in the value of inventory. Remember, all of those costs that are incurred to get the asset, the inventory, ready for its intended use, which is to sell, they're included in the cost. So freight in is added to the value of inventory. Freight out, however, this is after the inventory has already been sold. So it's not part of getting it ready. It was already ready. It was sitting on the shelf. Then we sold it. Now we're sending it out. Because it's after it was ready, freight out is not included in the cost of inventory, and instead it is an expense that goes on the income statement. So freight out, not part of inventory, but freight in is. Okay, so under these freight costs, they're broken out into two different terms. And we say it's either freight on board or free on board, as the textbook says. Sure, when I learned about this, it was freight on board. So if I say that, same difference, means the same thing. So we'll look at freight on board shipping point and freight on board destination. And these terms specify when the legal title or the ownership passes from the seller to the buyer. So therefore, who owns it, or when they take that ownership, and therefore who pays the freight. So free on board shipping point, the legal title passes when the inventory leaves the seller's place of business. So it passes at the shipping point. So as soon as it is shipped. Because of this, the buyer owns the goods. So the title transferred from the seller to the buyer at the shipping point. So during transportation, the buyer owns goods, and therefore the buyer pays for the freight. So whoever owns the goods during the transportation process, that is who will pay for that freight. So for example, if we're the purchaser and we're buying some sort of breakable goods, but they're really great goods and we know we can buy them and sell them for an even greater price, we may decide that we want to be in charge of the transportation. We want to make sure we hire a really good company, and therefore we put these terms of free on board shipping point. So that means that we take title as soon as they are shipped. Therefore, we're responsible for arranging the transportation, hiring some sort of shipping company, and therefore we, the buyer, pay for the freight. The second type, or terms that you may see, are free on board destination. So again, the legal title passes when the goods reach the destination. So the seller doesn't transfer title to the buyer until they reach the destination. Therefore, during the transportation process, the seller still owns them. So the seller still owns goods during transportation. Therefore, the seller pays the freight. So a different example here. So we're purchasing cars that are getting imported from overseas. So this happens quite often. There's lots of different, like Japan, they make quite a few different brands of cars. So they would produce them in Japan, and then they eventually, some of them get shipped to North America, so to somewhere in Canada to sell these. So if we are purchasing cars from Japan, they're likely to be transported across the ocean on large ships. So this is risky. There could be hurricanes, maybe even pirates. So because of this risk, us, the car dealership here in Canada, we don't want to take that risk. So we don't want to take ownership until those cars safely arrive here to us. Therefore, we would choose the terms free on board destination. Therefore, the company or the car manufacturer in Japan, they own those goods until they're delivered here to us. Because of that, they arrange the shipping and therefore they pay for that freight. So those are two different terms that you would see. And under these, you need to know who is paying and therefore if a journal entry is recorded. So it's really important, as it says here, in a world where goods are shipped long distances, like the second example. When goods are coming overseas, it's important to know when the title transfers. So not only to know who pays for the freight, but also for revenue recognition. So you can't record revenue until the title is transferred. Therefore, if it's freight on board shipping point, because the title's transferring at the shipping point, the seller gets to recognize revenue as soon as they are shipped because the buyer has taken ownership. If it's free on board destination, the seller actually still owns those until they're delivered. So they can't recognize revenue until those goods reach the destination. And if you're shipping overseas on these big cargo ships, that could be a long period of time difference. So again, it's important to know the terms, when you can record revenue, as well as who is paying for the shipping. Okay, so we need to look at two examples here to know who records these items. So right now we're talking all about purchases. So we are purchasing inventory under the perpetual method. Under each scenario, we need to figure out who pays the freight, either the seller or the buyer, and what is the journal entry for us, the purchaser. So what do we record when we buy this? Okay, so the first one here says JKL Company purchases inventory. The shipping costs are $1,000 and shipping terms are freight on board destination. Okay, so first we have to figure out we're the purchaser, when do we take possession? So if the terms are FOB destination, we don't take possession until they reach us at our destination. And this means that the seller owns them through that transportation process, and therefore the seller will be the one that pays. So the seller owns, so seller pays. So we are the purchaser, so there's no entry recorded because we're not going to be paying for this. We don't have an entry. Okay, so now part B, M&OP Company purchases inventory. Again, the shipping costs are $1,000, but now shipping terms are freight on board shipping point. So we figure out, when does the title transfer? Well, the title transfers from the seller to the buyer at the shipping point. So as soon as it's shipped. Because of this, the buyer, which is us, owns, so the buyer pays. So therefore, we actually are the ones that are paying this shipping cost. So we need to record a journal entry here. So since we're purchasing, we're paying to get this inventory in. So this is freight in. And as I said on this slide, freight in is included in the cost of the value of the inventory. So when we actually are the ones paying freight in, we record this as an addition to our inventory, because it's part of the cost to get that inventory ready to be sold. So we debit inventory and we credit cash for 1,000. Say to record freight in. So it's important for you to know the freight in versus freight out, as well as freight on board destination versus shipping point. Because examples in the textbooks may just say the necessary, or they say there's a purchase of inventory, terms were FOB destination or FOB shipping point, and then later on it would say that the freight was paid by the necessary party. Well, you need to know, based on what the terms are you the necessary party that needs to pay that? If so, you would record an entry, and if not, you would just note there's no entry. Someone else is paying. Okay, so that is freight in, and that's the final type of inventory cost on the purchasing side that we're going to look at. So it's just a little summary here, and there's an example with numbers. So we have a purchase, we could have returns or allowances, which decrease the cost of inventory. If we pay early, we also get a purchase discount, and then freight in is added to the cost of our inventory. So looking at these in T account form, in our inventory account, if we have a purchase, that is a debit. If we return something or receive an allowance, it's a credit. A purchase discount would also be a credit. And then if we have freight in, we would add that. But these all go through the inventory account when we're talking about the perpetual method, which is what we're focusing on. So overall, the cost of the inventory is $60,000, and that is all run through this inventory account. So those were the 4 items that we looked at. Okay, so that's purchases of inventory under the perpetual system. And then in our next few videos, we'll look at the selling side. So now that we've got all of these purchases, how do we record the sales of the inventory?